Headlines are screaming about a possible property crash in 2026, but the headlines have been saying that for a couple of years now. So is that actually data backing this information, or is it just fear-mongering? If you as an investor had listened to the media over the last 3 or 4 years, you might have put investing in property off for several years, which could have cost you tens of thousands of pounds. Today, we're cutting through the noise and we're answering one question: will the property market crash in 2026? Over the next 10 minutes or so, we're going to cover 3 topics: the reasons why people believe there could be a property crash in 2026, whether those fears are backed by any real data or genuine information, or whether it's just rumours, and finally, what we actually expect to happen in 2026. If you're new here, welcome. My name's James. I'm the co-founder and managing director of a property investment consultancy called Freighter Property Partners, but this channel is all about your education. If you like the video, don't forget to hit the like button and subscribe to the channel, but let's get into it. So what are the reasons why people think there could be a property crash in 2026? The first is a sudden hike to interest rates in 2024, which meant there was a lot of uncertainty in the market in the last 12 months. Obviously, when there's changes in the market, people take time to really understand what's happening and what's likely to happen moving forward. But the major concern for most people is the 18-year property cycle expecting a crash in 2026. This 18-year property cycle has been correct twice in the past. So is it going to be correct a third time? And what do you need to be aware of as an investor? But before you panic and start to sell off your whole portfolio before this crash, let's actually look at the information and see whether a crash is likely in the current market. So what actually is the 18-year property cycle? It's a piece of theory that predicts that the property market and prices of property go through 4 distinct phases. That's the recovery, the market correction, the boom, and then the crash. Obviously, 18 years on from 2008 takes us to 2026, and that sounds pretty scary to a lot of property investors. You don't want to necessarily buy a property and then see the market crash. But the property market has changed in the last few years, and here's why we believe it's fundamentally different to what we've seen in the past. The first factor is we have a chronic housing shortage across the UK. The fundamental premise of this cycle is an oversupply of property creates this crash in property prices. We've not seen an oversupply of property, and actually we're seeing a dramatic undersupply in property in the UK. This means that when demand is high and supply is low, prices will only continue to increase moving forward. In certain areas of the country, property prices have slowed, like in places like London, but the reason property prices have slowed and even dropped is because of a lack of demand of properties because of the lack of affordability. If there's a lack of affordability, the demand drops, which means prices slow and then drop in value a little bit. In other areas of the country where there's still really strong affordability, property prices are still growing and will continue to grow because of this massive demand and the lack of supply across the country. In recent months and even years, the government have come out and said they're trying to deliver more and more homes across the nation. However, we are way off the targets that they put in place, and even if we were on target to those targets, we'd still have a massive undersupply of property, which means prices on the whole will continue to grow in value. The second factor is the demographic shift. We've got an aging population of people that are living in properties for 20, 30 and even 40 years. Those people aren't moving, which means that there's still a lack of supply of good quality housing for people in their 30s and 40s that want to live in bigger homes. This again artificially restricts supply in these areas, which means property prices are only going to increase in these areas where lots of people want to live and can afford to buy their homes. So for these 2 main reasons, we believe that the 18-year property cycle is ultimately broken. Its underlying mechanism that there's going to be an oversupply of properties is obviously not correct in the modern day in the UK, which means property prices are only likely to increase in areas where demand is still high and there's a lack of that supply. This means that we can stop worrying about outdated predictions of models that don't reflect the current market in the UK. So with the 18-year property cycle now firmly off the table, the experts like Savills are projecting quite a positive 2026 for certain regions within the country. Although growth nationally is expected to be relatively modest, it further creates the north-south divide when we're looking at possible growth in property prices. London is only expected to grow from 0% to 1% within the next 12 months, and other areas in the country we're looking at growth up to 3.5%. When we then start to think about that these investments are leveraged, it starts to paint a significantly better picture and give us the opportunity to continue to scale our portfolio and grow into a position that help us work towards our long-term goals. The general consensus is property prices will grow the most in places where it's still affordable for the local people to buy their homes. Those places include the Northwest, Yorkshire and areas of the Midlands. This positive outlook is mainly driven by stabilising rates, as well as the Bank of England cutting the base rate at the end of the year. This improves affordability for home buyers, as well as improving rates on your mortgage as an investor. With that improving rates produces more confidence, and more confidence means more people are looking to purchase property in the current market. So if we look at the data, it's settled. 2026 is not the year of a property crash, it's the year of consolidation and relatively stable growth in regional locations where affordability is still there. But remember, property is a long-term play. Only looking in the next 12 months doesn't guarantee our success moving forward, so we need to make sure that everything we do is based on real data and long-term fundamentals. Although it's cliche, it comes back to the saying that people love to say within property and other investments, that time in the market is way better than timing the market. If you have the cash to invest in property, the time to do it is now. You don't want to put things off year after year because you're missing out on significant returns, which could be giving you an opportunity to build for your pension or replace your income. The greatest difference between successful investors and amateur ones is the ability to look 5, 10, 15 years down the line. If you're going to invest in property, you're going to want to hold that for a minimum of 5 years, and that's where property starts to really come into its own and give you the opportunity to really build your wealth through refinancing properties and scaling the portfolio. Even if you bought at the peak of the last boom back in 2008, it wouldn't have been the end of the world. Yes, in the short term, it would have been scary because you could have been in negative equity, but you would have received rental profit every single month in that time frame. And then once the property market recovered after a couple of years, you had the opportunity to continue to build your wealth. Those property prices grew and grew moving forward, which gave anyone that did invest in 2008 who didn't panic and sell that property the opportunity to continue to grow their portfolio through refinancing and scaling further down the line. That is the power of owning property for at least 5 years. If you're investing in property for the long term, you're going to see times where the market is better and the market is slower, but you're going to write those times out and give yourself the best opportunity to really build your wealth. You don't need to predict the crash. You just need to invest in the right locations and hold property for the long term to give yourself the best opportunity to build your wealth through property. If you're looking to scale your property portfolio over the next 12 months and you don't have time to do it yourself, or you're investing in locations you're not familiar with, then I'll put a link to our website, Freighter Property Partners, in the description, and you can have a free call with one of the team. But that is it for today's video, so I hope you liked it, and I'll see you soon.